What's going on, everybody? So Cathie Wood and the grifters at ARK Invest have a new fund called the ARK Venture Fund. And let me tell you, this is just, it makes my blood boil, but it makes me laugh at the same time. And really the reason I want to kind of look at it and make fun of it is so that we can all help make sure that our friends and family don't fall for this nonsense. Now, let's take a look, and I think you'll see why I'm saying this. By the way, this is a video that didn't get a lot of attention, but it was from late September. I think it's going to cover a lot of the topics we want to see.
Brett, what are the goals?
Well, we aim to democratize venture capital, and I think you just described exactly what we're trying to do. Anybody can, right now you can go into your browser and you can type in ark.vc and you can download the Titan app and you can invest $500 today into venture capital.
Okay, let's start off by just noting the obvious. I want to look at this from a marketing perspective. $500 minimum, democratizing, these are all like, reminds me of Robinhood's marketing language. They're democratizing, the investment game or whatever. The $500 minimum implies that it's, meant to be open for, call it the younger investor, the newer investor, the investor who's maybe not as affluent and probably less informed. If
you think about venture as an asset class, it's really been held apart from.
By the way, I just want to say this guy looks like he's been up all night. I'm not, no offense. He's a fine looking man, but he looks a little worn down.
A lot of individual investors
probably got off the phone with Cathie Wood and she's like, "You're going to do it. Okay. I went on TV about the transparency ETF. We know how that did. Okay."
These are not assets that should require you to be rich in order to invest in them, nor should you have to fill out a lot of PDFs and only be able to get into the top funds if you're the Yale endowment. We think that every individual should have access to venture capital if within their risk tolerance limits, and we think this vehicle provides a mechanism by which they can do so.
So, quick question. How much does it cost? Because I've always talked about this on the CMQ Investing podcast. The costs matter. What is the cost that you are incurring to invest? Because those costs compound as well.
On this mechanism, as you called it, for a little bit of time, our Bloomberg Intelligence ETF analyst, Eric Balchunas, who you guys know well, has a note out in response to your launch titled, "Cathie Wood's Venture Fund, Burdened by Tough Timing, High Fees."
Let's see how he responds to this.
Let's start with the timing. It's been brutal for both public and private markets of late. How do you get around that?
This is the perfect timing. This isn't tough timing.
Now, consider the source here, right? What is his incentive? It's to get assets under management. So, of course, it's the perfect time.
Bill Gurley said it the other day, there's never been a better moment to start up a business, and I think there's never been a better moment to put...
By the way, this feels like trolling by the producers.
There's roughly $8 trillion in market cap attributable to the innovation platforms that we focus on, and that's going to more than 200 trillion by 2030. So there's incredible technological tailwinds in play, and so when everybody's running for the exits is exactly the time to be putting your capital to work.
Yes, but there's a but here. Unless you're putting it to work in something that's super risky or that you don't fully understand or that it doesn't have there's plenty of reasons when it's not a good idea, but let's look at the biggest reason why to not do this has to do with the costs.
Let's talk about fees then. I think
yes.
Typically ARK's existing ETFs carry a fee of 75 basis points, 0.75%, right? And in this case, it's a fee of 2.75%.
Say what? 2.75%. And if you include everything, it's over 4%.
Expense ratio, therefore, of 4.22%.
Woo! Oof.
That seems high. That seems high.
That seems like it might be the highest we've ever heard of.
Why is it set?
I love how friendly that is. It seems high. He knows. It's super high.
It's at that level.
Well, think about the comparable products you could get if you're investing in venture, where you're paying 2% management fee plus 20% carry.
Come on, man. So what he's trying to say here is that if you look at hedge funds and the hedge fund model, this is a better deal than that. But this isn't a hedge fund. This is a Cathie Wood fund that combines public companies and private companies. So it's not, you're not getting, I'm not even a hedge fund advocate, but the hedge fund fees, the hedge fund fee structure is not something to be proud that you're better than. And it's also implying here that there's a certain level of, Cathie Wood doesn't hedge. Come on.
So this is a much more efficient exposure than you would get if you were in a top quartile venture fund, which have done quite well. And so the
4.22%, guys. That is brutal. Brutal. And also, I looked at what the public companies are, the 30%, and they're a lot of the companies that are in the other ARK funds. So it's not some, specially crafted thing, or at least not as specially crafted as it sounds.
Investment vehicle itself restricts our ability to charge carry. That's how we could democratize this.
Shut up, dude. Sorry, I don't mean to be unprofessional about this, although this is not a professional channel. Just come on, man. I just can't. They should have gotten Cathie on here because at least she could sell it.
Restricts our ability to charge carry. That's how we could democratize this. And so we believe we're charging an extremely efficient rate for getting access to top tier companies. These are companies that
I also just noticed something. He has a sunburn and he's in Los Angeles. Makes me think he might be having a little too much free time.
A typical investor couldn't get access to. And so
yeah, because we don't need access to this, especially this way, where I'm going to pay 4.22% for Cathie Wood to pick stuff that, well, just going off her unbelievable track record, it's probably not going to do that well.
By just going to ARK.VC.
How are you going to beat the market with a 4.22% expense? How is that? The odds are so small.
Right now, you can invest in this fund and get access to these kinds of great innovation companies.
God, this guy seems like he's like going to have a panic attack.
Redemption's capped, right?
I feel like this is the face of a man who's like, what am I doing? I gotta start talking to some recruiters.
At 5% of net asset value on a quarterly basis. And what's so interesting?
What annoys me about the traditional financial media, and I mean no disrespect, I mean this just as an outsider looking in, why don't we check this guy a little bit more on what he's saying? I feel like these turn into just really nice advertisements, for these different fund managers. There's a great opportunity to ask some follow-ups here that are a little more poignant.
Interesting here is that
everything's just interesting. It's really interesting how you're just creating something that's most likely going to result in people losing their money.
Split is 70% private, 30% public, but traditionally capital is locked up in VC funds for a very extended period of time. You guys are also looking at investing in other VC funds. How do you manage that? Some redemptions with the need to lock up capital in the private sector.
Yeah, so redemptions are capped at 5% across the entire fund, but if an individual investor wants to sell their position and the overall request for redemptions are below 5%, they'll get their entire position sold out at net asset value.
Okay, this is a little bit dodgy. What they're alluding to here is that this is a very illiquid fund, meaning if you want to sell, you can't. Your money is tied up.
It's only if...
Which, by the way, if you're in a business that profits from assets under management, what a great structure for a fund. We're going to charge you 4.22% and not let you take your money out.
If requests to redeem exceed 5% in a given quarter, then redemptions happen on a pro rata basis. Another difference between our fund and typical venture is that the money that inflows into the fund can get allocated to innovation assets immediately in the public markets as we're negotiating private market deals. And so, at equilibrium, we're seeking to be, like you said, targeting 70% private exposures. But on an individual technology basis, we will play arbitrages between the public and the private markets.
Arbitrage. But are you making me money?
Some technology.
Arbitrage, or are you making me money?
It's very clear to us that the private markets are undervalued relative to the public markets and vice versa. And so...
it's very clear to us that we can make more profit off of you suckers.
We think this is...
By focusing on... it's great with a private company, you have practically... it's a small fraction of the information you have on publicly traded companies. So I wonder what information investors are going to have on these private companies. I would imagine pretty much nothing other than what's already available, on their websites or things like that. Because that's, if you're a private company, you're not obligated to share those details, meaning your financials, how you're growing, et cetera, et cetera.
Is a really interesting way to get...
It also opens up opportunities for, kind of goofy valuations that don't get checked.
exposure to innovation tailwinds that will allow us to invest in these companies early and carry them all the way through IPO into the public market book.
We just showed a chart there of the S&P 500's outperformance relative to ARK Innovation ETF, right? This is
now, see, I was annoyed at this, but it's funny because they're being very polite, but they keep being like, we've also noticed that we just showed a graphic of how you're doing so terrible. Oh,
a different strategy. But
this guy's like, you piece of...
How do you convince investors that this is right, to use this new mechanism, this new way of getting access to private markets and private companies?
I think that any innovation exposure should be measured over a business cycle length performance basis. So when we underwrite our positions in the private market and in the public market, we look forward 5 years and say, what is an in-market investor going to pay 5 years forward, who's not even a technological optimist like us, but just paying a market multiple for the cash flow generation capabilities of those businesses.
Right.
I think that
this guy is now in this, he's sweating right now.
Particularly given what's happened with rates and with innovation assets across the board, investors are short innovation today, maybe unintentionally so. The disruptive technologies that we think are going to penetrate the marketplace are going to totally turn over the business models of incumbents that
we get
in
it.
their portfolios. All of the problems that we're seeing in the world today, innovation solves those problems. And so owning the businesses that are going to solve those problems is a way to generate outperformance over time.
All right, let me just stop with that and leave us with one of my favorite quotes from Warren Buffett in 1999. I always like to go back to this. Buffett said that he won't dwell on other glamorous businesses that dramatically change our lives, but concurrently failed to deliver rewards to U.S. investors. He mentions the manufacture of radios and televisions. But I will draw a lesson from these businesses. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company, and above all, the durability of that advantage. The products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors. This is a premise that is true. Much of what the ARK folks talk about is based on a false premise. The idea that, there's star stock pickers who can outperform the market over, meaningful periods of time. The idea that, a fund that has an expense of over 4% is somehow going to be advantageous for individual investors. The more you read about this stuff, and I encourage you to go back and listen to all the episodes of CMQ Investing, because I've uncovered this through that process. But if you go back to that and just do a little bit of reading, you realize that these claims are asinine. They are not claims that I would be able to make, and feel good about myself making them. I find it to be very questionable to see professional people say things that they have to know are not true. Be careful with your investments. Cathie Wood she's bad news. And I think this is just another example of, and I really think this fund actually kind of just illuminates what she's all about, right? It's all about making money. It's not about helping people, build wealth over the long term. So with that being said, I hope you enjoyed the video. I want to do more like this. I can record them faster and just give you something authentic that doesn't take as long to produce. So if you like it, let me know in the comments. Give it a thumbs up. Please subscribe. For CMQ Investing, I'm Chris Franco. Thanks again, guys. Later.